Good morning. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for March 3rd, 2018. Market remains in bullish volatile conditions on an annual basis using weekly RSI 14. We're at 55 out of 100 in the middle of neutral using the 10-day NDX. On the 10-day condition, we are at the low end of neutral at 30. Looking at the market mosaic, price with respect to the 200-day moving average is yellow bullish at 5.08%. The slope of the 50 is red bearish at 0.13%. ADX remains a strong trending 28.8. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and off. We just moved back into risk on conditions on Friday with a score of 1.02. We take that score, compare it to the last 5,000 trading days, find the average and the standard deviation to compute the risk Z, which comes in at 0.14, meaning it's 0.14 standard deviations above the long-term average. This is the 90-day histogram of that indicator. You can see the normal oscillation during a steady grinding bull, and then the panic sell-off, which was a 4 sigma event. And then a sharp recovery, which featured one of the best 10-day periods in history, and now a bit of stabilization and sideways, and even a resumption of the selling this past week. So we'll see what this week brings. But in terms of volatility, we did tip back just into the risk-on condition, taking that one with a grain of salt. Blended month rebalancing, these are the holdings for the month of April and the leaders in the clubhouse based on the closing prices on Friday. In ETF2, the theoretical exposure is right at 50%. So this is more than one indicator which is showing the market balancing on a knife's edge, between the overbought, oversold, and the risk Z, and a volatile market. We're poised for sharp moves in either direction, either as a continuation of the gains or a continuation of the sell-off. I'm expecting more sharp moves ahead. Quick look at the ETF 13 and 32s. It's a mixed bag in terms of buy and sell signals. You can see even the leader candidates gave back considerable amounts this past week. Only treasuries in the green. Among the Dow 30, leaders continued to lead. Intel offers the most interesting one to me. It resisted the sell-off the most. Caterpillar suffered the most, followed by DuPont. So this is the XLB sector that really got smacked. McDonald's is going to be interesting on a value play. Fund managers have to own McDonald's. They have to own Coca-Cola. And they have to own General Electric. So there's some deep value plays being developed there in the Dow. Among the sectors, software and services held up well. Innovative technologies had an interesting week and month. But you can see the industrials, materials, and financials, the three things that have been the leading candidates for relative strength this year so far, all suffered sharply. Among the ETF Max, it was really the inverse volatility-based products, or I'm sorry, not the volatility-based products, not the inverse, that were doing well. Nickel and cocoa and social media. In the market health check, you see this Mr. Toad's Wild Ride cranking up the hill, the 4 sigma downward event, the outstanding 10-period or a 10-day rebound, and then a 50% retracement of that rebound, holding right at the edge of the river, and then a positive day on Friday. If panic were to come into the market, I would have expected it there Friday. In fact, we were prepared for it, but in this buying after the gap down and the buying pressure, we ended up cashing most of our shorts over the weekend, which I'll cover for the advanced swing trade course in the next video for that course. But we were able to make some bank inside this really 4 days of selling followed by a 1 day of recovery. So this is a market that's poised right on the edge of further collapse down here to 260 or a nice rebound. Were it to gain right here, then we would see this as a low and a higher low, and then that would be a P4 pattern coming back to test 284. But were this to fail, 266, then we'd be seeing, I think, a retest of the 10% sell-off and then maybe down to 15%. The MACD histogram PPO had this about a 4 sigma sell-off, crossed the signal line, re-entered the river, crossed the zero line, all as part of this really good recovery. And then this sell-off produced a reversion back to the zero line and now a slightly negative bias, but again, really poised right along that zero line here. So this is another indicator showing the basic lack of direction to the market as people try to line up on either sides of the teeter-totter. So we've had 2 big reactions so far, each one half the size of the previous one. So tomorrow we could see a move to 274 or a collapse all the way down to 261, and that would be perfectly within the realm of normal. Slope of the 10 period and the 30 period RAF regression channels are down. So again, a market that is in the middle of indecision. This favors shorter term time horizons, so swing trading on 30-minute up to 2-hour bars, and then also taking advantage of 1-day directional moves. When you see very large real bodies compared to this to the relatively small wicks, then what you have is an intraday trend, and those become tradable, but really for 1 day only. You can't really rely on these things being multiples. It was a bit unusual to see 3.5 days of directionality in a row. But again, this chart formation favors the shorter term time horizon. ETF regional report, this should read 50% and 0% because of the 5 symbols on the cash. The S&P at 55 is still better than EFA at 45. Inside the U.S., it's technology, large caps, small caps, mid caps. Technology and Latin America are the best. European 350 and Asia less Japan are the weakest. Inside the U.S., weakness here in staples and utilities, strength in technology and discretionary. It's really technology and large caps and the growth side of the U.S. right here. Weakness on the small cap and value side. Mixed bag in Asia. Everything weak in Europe. Again, a real distinction here in the business sectors. I'm really surprised at utilities suffering so much in this downturn. I still think there's a serious opportunity for hunting yield on sale there, and so I will continue to stock that idea. Among the ETF top 30, technology based on the strength of Intel had some gains, but the leaders continued to lead: Latin America, Brazil. This just showing the ETF liquidity, the most liquid symbols based on average daily dollar volume for the last 30 days. Technology has really taken back over the second place position, now trading twice as much as the Russell 2000. That reverses a trend of the last 2 to 3 years where the Russell was the trading vehicle of choice. So new vigor being brought into technology. Shifting to the daily report here. EFA on a overreaction signal. Max Pains continue to be the Max Pains. Walmart, Caterpillar, McDonald's, DuPont, GE. I have been stalking that end of the value curve because I feel like a lot of the risk has already been taken out of it because of the size of that sell-off. But certainly, these are the key. These are the ones here that have resisted the sell-off the most inside their respective populations. Just about everything in a good position for the auto framer because of the market's condition. only a handful of dojis were formed, but lots of channelings because of the recent sell-offs of the last week. And here again, you can see the reward to risk ratios using the auto framer. Intel, Apple, Microsoft have been quietly leading the way down here. You can see their the gains they've been making over the last 1 day, 10 day, and 1 month periods. In the ETFs, again, most of them, or half of them, are on auto framer good plays, 4 or 5 DDs to choose from. Real estate materials will be interesting to me because of the harshness of the sell-off. It's a 5DD, it's a 2.8 on the auto framer, and it's both channeling and overreaction, so I'll be framing that one for the advanced swing trade course students and in our next webinar and video. Among the daily pinch, Intel, Cisco, and Apple showing strength here in the technology area. Brazil, Latin America also showing well. The negative Z stretches, McDonald's, Walmart, Caterpillar, Home Depot. When you see a -4 sigma, it has to be of interest to you. Walmart and McDonald's both. I mean, those are 4 of the great companies of America right there. McDonald's, Walmart, Caterpillar, Home Depot. So I'll be investigating those. The most expanded pinch boxes, these are the 30-day directional stretches. The rivers are very wide. And this is the sigma of how wide those are. Quite extraordinary moves over the last month, as we know. No super pinches. And then these are the symbols whose pinch boxes are most compressed. And so I take that as a good sign that Latin America and Brazil are ready for breakouts in either direction. Stats from the auto framer with the mechanical entries mapped out for you. Regression line fractal framework, top shelf. These are the deep value plays and how many ATRs below their long-term fair value they are. That's the size of the value that's baked into the cake. In the red, these are how many ATRs they are above their long-term fair value as marked off by the RL270. So lots to choose from there. Daily squeezes. These are symbols that had a relatively small range on Friday compared to their usual range, which means they are poised for potential breakout from a compressed position. And then when you frame it in the standard way, you get the reward to risk ratios expressed here. So Home Depot, United Tech, Johnson & Johnson, Walmart, all looking interesting on that one. So Walmart would be on my short list for sure. Market mosaic, the polynomial regression line still rolling up, but the 30 has rolled down, crossing its own 10-period moving average here, almost 3 standard deviations below the long-term normal. That is a potential turning point. We're either going to get another big collapse like we saw here, where that second wave failed another almost 2 standard deviations, or it's going to recover from here back to the +1. So again, a market that is poised for sharp moves. And if Trump tweets another irrational idea like a 25% tax on tariff on steel, the market will respond accordingly. When you have a child in power, you got to expect that kind of impetulance, or petulance, I suppose, is the right word. The slope of the 30 is one of the one of the top 10 worst of the last 10 years. Each time when that rebound occurred, though, I want you to notice there were some really nice recoveries on the upside. So that's why we have to be prepared for that buying quality on sale trade. I'll be covering a lesson on this one at the start of the week. In other words, last weekend, this RL10 slope had just rolled over to here. And we talked about the inherent weakness of this market as a result of that. Here, the 30 had already sold off harshly, so the market was bruised. The 90 had cooled off, so that even the long-term holders were being very, very careful. The enthusiasm was running out of the market, and the 10 had just made this almost 8 sigma move from -6 to beyond +2, and hard to sustain that. The 10 period guys were all enthusiastic in and had made their money and were pausing, but the 30 had their emotions bruised and were not really ready to fully embrace this. So there's an anomaly between the shorter term guys who are fully satisfied and wanting to be protected, but the 30s and the 90s not yet ready to buy. And so in that vacuum, the sell-off is and return to the mean is the least surprising move of all. And so that allowed us to get short this past week and make some nice short-term swings inside this move back to the bottom of the river where Friday's price action held. So that's the posture we're in right now, on the bottom of the river, of an expanded river with lots of emotions to process and wondering if and when we get back to this normal. Was this even normal? So we're right back where the market had ground its way up to just before this extremely unusual January move. So this is the anomaly here. And we're back at what long-term fair value was at the bottom of the river. And that's why we're poised, ready to go in either direction. Keep your risk measured and your powder dry. This is Ken Wong at Tortoise Capital, and we'll see you in the chat room. Oh, I should also say we just started the another series of online swing trades students who began 1 March. I think I will start a new one probably around 1 August, or as soon as we get done with our Kansas City research weekend. So that'll be like the end of the second week of August, I think, is the next program time for me to resume that. So keep us in your on your schedule. It's Ken at Tortoise Capital. See you in the chat room.